If you look back at 2017, what led us higher? I think a lack of alternatives, given the fact that interest rates on the 10-year are closing calendar year 2017 where they did 2016. I think the honeymoon period usually lasts about 6 months with an incoming president. It's been lasting the whole year. I think the promise of tax reform, the promise of repatriation, the promise of health care reform, less regulation, all has led to a new kind of animal spirit for the markets and optimism that companies, the balance sheets are stronger, and that balance sheet should be working positively for investors even into the incoming year. I think it's going to be a major story now. Could hasten the end of the recovery if interest rates have to be ratcheted up by the Fed too much, but that remains to be seen. But right now, if you're looking at 8% additional earnings boost to companies that should grow at about a 10% pace next year, you're talking about 18% earnings growth next year. Let's say half of that is factored into the market. So in our opinion, you're probably seeing low teens in total return next year, at least as we sit here today. Well, I think one of the reasons we'll never see it again in our lifetimes is not because of the return. If you look at the average return in the market, maybe it's 9 or 10% a year, but there's been many years where we've had upper teen returns. And so that wasn't the difference this year. I think the difference this year was a lack of real volatility, no real correction, 5-6% maybe the max this year. So that's an anomaly, some of the least volatility we've seen in the market in nearly 60 years. And I also think when you went into this year, given the fact that Donald Trump is probably unlike almost any president we've ever had, if not any president we've ever had, as far as the animosity he created, but also the favor he really created from those that really liked him, I think we thought 2017 was going to be much more volatile than it's actually turned out to be, thankfully. Generally speaking, we work upon the premise that if you get the direction of the market right for the foreseeable future, and sometimes that foreseeable is different in sometimes than in others. So if you get the direction of the market right, that's all you can really ask for. Going into 2018, we are positive on the market. Maybe it'll do upper single digits. I mentioned earlier, mid to lower teens. If some of this tax reform is not priced into the market, I think we also have to look at a reduction in regulation and then repatriation. What companies do with that money that's come over from overseas. Do they buy back stock, which reduces the number of shares and boosts earnings? Do they increase their dividend, which is also usually treated favorably by investors? So going into 18, we are positive on the market and look for maybe 8 to 15% type of return. But like I was saying earlier, it's getting the direction of the market right that's much more important than getting the magnitude of that move. Probably higher interest rates. A credit-induced recession, we've only had about 2 or 3 in the history of our country. Usually it takes about a decade to resolve. And if the recession ended in the latter part of 2009, we're coming up on a decade during the latter part of 2019. With that will probably come higher interest rates. And you couple that with tax reform, so you probably see interest rates moving up into the 3% range this year. We hope it comes towards the end of the year because a 3% move earlier in the year would probably worry stock investors a little bit. Right now we're about low single digits allocated overseas. That takes into consideration international mutual funds, global mutual funds with assets outside the United States, ETFs internationally with international type of design, and also foreign companies. We expect to continue to work at bringing that up a little bit as we do see some sort of reversion to the mean of international, beginning to do at least on par with the U.S. markets. So stocks over bonds for 18, we believe. Also, your dividend growers over your higher dividend paying stocks. So we're not big fans of utilities or telecom because their earnings aren't growing that much, and neither really are their dividends. And I think some of your consumer non-durables trading at 20, 25 times earnings with really a lack of growth, we don't really favor either. So I would stick with those economically sensitive companies, industrials, your banks as the yield curve steepens. I think your banks and other financials will do well. And I wouldn't turn your back on technology because despite the fact they really won't get that much of a tax boost from this tax reform, they're still your fastest growers in the 9 or 10 industries. I think I would ratchet down the real high flyers like an NVIDIA. I would still be buying Microsoft. I would still be buying like an Alphabet. Ratchet down your really high flyers and look for those that, might have been bypassed a little bit this year. On a total return basis, I would not be surprised if the market performed in the double digits. How high, I don't know for sure, but that's what we would plan for. On the bond side, higher interest rates, approaching on maybe 0.25% on either side of 3% on the 10-year Treasury note. What areas will do well? I do believe your larger cap stocks with domestic revenue, a majority of the revenue coming from the United States will do well. Your smaller caps for that same reason will do well. International should do well. And we do like those economically sensitive stocks and technology. We are telling them to stand outside for a little while where it's 5 degrees to cool them off a little bit because they are expecting much better returns than we would. In fact, if you're looking at distributions from your accounts, we recommend no more than about 5% of the balance in order to kind of not guarantee but feel comfortable that the principal will be relatively intact over a full economic cycle.